Hi, my name is Z from Optionality. I am a professional options trader returning 25 to 50% cash on cash in my trading portfolio every year. And today we're going to explore selling puts and seeing if it actually outperforms buy and hold. Let's begin. Note that this is not financial advice. Options trading is risky, and this is for educational purposes only. So selling puts is it's a strategy where you're making a bet that a stock is not going to drop to a certain price by a certain time. It's a very popular thing to do because we've been in a bull market for a really long time. You don't really lose money in this particular fashion, and you can slowly see your account increase every day as the premium goes off. And even if you do get assigned, you basically, you can just hold the stock and wait for it to appreciate and sell for a gain. Now, let's compare. We're going to run a benchmark on a bunch of put selling strategies and see if they outperform buy and hold. The methodology would be we are going to start with $100,000 cash. We're going to simulate selling SPY puts. As many SPY puts as possible with our portfolio, and then we're going to benchmark this against SPY. I'm going to try many different deltas and many different durations to see if there is a strategy with a particular sweet spot as to what to sell to maximize our profits. So as a disclaimer, the data comes from Alpha Advantage. They basically have agreements with CME and a bunch of other providers. They have end-of-day data. They collect all their data at 8:45 p.m. Eastern time, so it does take into account a little bit of after-hour activity, but they also have open-close data for both options and shares. I started my back test mostly on June 1st, 2020, and that's when weeklies were introduced. Now we have dailies, which is quite awesome. It's hard to imagine before 2010, there was only monthlies and quarterlies. There was just no volume going in the options market. And now the options market actually dominates sometimes the shares market, which is pretty incredible nowadays. And what we're going to do is we're going to hold until expiration and settle to cash. So if SPY ends the expiration below the strike price, we're going to simulate selling, getting assigned and immediately selling at the close to cash, so that the next day we can just do the exact same thing over again. So I do want to take a look at SPY. Let's see. So here's SPY. And in June of 2010, we're somewhere in here. I mean, this is relatively close to the market bottom of that bear market, and we really have never had a bear market since then, like a proper bear market. This other than a couple of flash crashes here and there, and we've been just on this monster bull run, so it's generally been really hard to outperform buy and hold, unless if you're like scalping or actually actively trading. So SPY on June 1st closed at 107.53. With $100,000 of cash, you could have bought 930 shares, almost 930 shares of SPY. And as of the close on August 30th, which is when I'm doing this analysis right now, SPY is at 563. So that's over a 5x gain, which is absolutely incredible for 14 years. And those, 930-ish shares of SPY would be worth $524,000, 207 without any dividends reinvested. So with dividends reinvested, this would be a much, much larger amount. But we're going to just kind of keep things simple for today. This is the number that you should be comparing all the benchmarks against. So let's take a look at the results. So Optionality, the platform gives you the ability to backtest option strategies. What you can do is you can set up a start date of the back test. You seed it with some amount of cash. You tell it the account type, either cash or margin. We're going to start with cash. We're going to look at some results with margin in a little bit. Margin just means that you can sell more puts, basically. And you get much higher volatility in your portfolio, which you will see. And we will, and then you get to specify strategy. So for this particular strategy, we're going to just sell one SPY put on 0.1 or multiply by 100 because there's 100 shares per contract. 10 delta with 7 day 2 expiration, and we're going to do it as much as we can. So you'll see in the trades on the first week we sold one, got $43 for it, and then we kept on selling on that day until we ran out of margin buying power, and then that all expired worthless, and then we did it again a couple weeks later, and then we just kind of keep rinse and repeat until the year 2024. So, and I did this for 10 delta 20, 30, 40, 50. We also varied by day 2 expirations. I have all this in a table, but so I'll share it in table form so we can see the trends. But looking at the results, so here there's an overall P&L number, which is $53,400 ish. So this strategy returned 53% over the course of 14 years, which is 3.75% annualized. And the average profit on winners is expectedly pretty close to 100%. You sell premium, most of the time it just goes out worthless. But when you lose 10 times more than you take in as premium. So you have a really poor risk reward of 0.1. Let's take a look at the results in table form. We can do the same here. Now note that, buy and hold. So let's take a look at the results. Here's all the DTEs, and buy and hold returned $24,000. So if you just went out every single week and you sold puts, 30, 40, 50, some reasonable DTE, you would have underperformed SPY by quite a large margin. In fact, you would have done better. So the higher delta you go, the better you would have done, because it kind of simulates you holding those shares. The more delta, the more of a directional bet that you're making, as opposed to a volatility bet where you think that the market makers are overpricing the options, where there's more demand for these put options. It's just been a better bet saying the stock is going to go up, and the best way to do that is to just buy the shares. So, well, let's take a look at what kind of happens in different environments. So say we are in, you would think that selling puts got to win in certain environments, such as like sideways environments and maybe even on drawdowns, right? So for example, we have a little flash crash that happened, at the beginning. This is a COVID crash right here, in 2020, at the beginning of 2020, where SPY dropped, 20-30% over the course of just a couple weeks. Well, selling puts probably outperformed buy and hold, right? Because you're taking in premium every single week to offset the amount that you lost in share price every single week. Well, that is true. So let's take a look. So at the ending balance at the very top is this column right here, and at the top of COVID, and the balance at the bottom of COVID is in this column. And you see that here is the drawdown for all these different DTEs. The lower the delta, the lower the drawdown that you kind of suffered. Whereas at 50% DTE, you got a 24% drawdown, which is relatively close to the SPY drawdown. So yes, you do outperform when the market goes down. But here lies the problem with selling puts. So now SPY goes and does this absolute massive rip, like 100%, gain over the course of a little, maybe like a year and a half, from the bottom here, March 23rd, all the way to the top in December of 2021. So let's see how did selling puts do compared to just buy and hold the shares. So here is the balance at the bottom, and here's the balance at the top. And you see that the recovery, the more delta that you have, the bigger percentage recovery you had in your account. However, the problem is that selling puts pales in comparison with buy and hold when it comes to appreciation on the upside. Because you're just holding shares, it's for every dollar it just goes up, whereas as you're selling puts, every dollar SPY goes up, you get incrementally less and less benefit from selling puts. And the difference is very, very large. You would have made over 100% on the upside, whereas if you were just selling puts, you would have made 30, 40, 50 max. I mean, nobody's selling 50 delta puts. That kind of defeats the point of selling puts. Honestly, might as well just be buying calls at that point. But your gains are very, very modest when you're in a bull market when you're selling puts. Well, Z, let's talk about sideways price action. Like, what happens if the market goes sideways for a little while? So here we have the market at the very top. The market went sideways for 2 years. Well, yeah, right around 2 years, right? So you would expect put selling to be outperforming because the market went sideways, whereas premium selling strategy, right? Like, shouldn't you be collecting premium the whole time, offsetting the drawdown or the sideways action? Well, let's take a look. So at the beginning of 2022 to the end of 2023, you see that SPY has not changed that much, basically 0%, but the sideways yield has actually been negative for most of the deltas, and it's only positive for one of the deltas because you basically got assigned every single time down, every single time along the way. You're not getting paid enough for the puts that you're selling, basically. So you take full risk, or you take most of the risk on the way down, you get paid very little, and on the way up, just like how we were in a bull market, it doesn't really pay you out. So you actually end up losing money in some of the deltas here. So one thing to note is that if you look at the trades at the very end of this, you'll see that we stopped selling very many puts at the very end of this. And that's because we just run out of margin. We just don't have enough cash in our account to be able to support selling more than like 1 or 2 contracts. Whereas at the very beginning, we were selling 9 contracts, which is like, equivalent of 250 shares of, if you're at 50 delta, 450 shares of SPY. So imagine you're holding 900 shares of SPY, while towards the end, you're not really, getting the same. It's not as fair anymore because the price of SPY has just gone up so much. So one thing I did was I tested selling using a margin account. So we say, okay, we're gonna be able to sell with 4x leverage. Okay, so instead of providing $50,000 to buy to sell one contract of 500 strike SPY, you only have to do a quarter as much. So you can actually sell as much as 9. You can sell as much as possible. And to make it fair, we say we sell at a maximum of 9 contracts at any point in time. So how does this do in terms of our P&L? So you see, with margin, you make a lot more money because we've been in a bull market. The more positive delta you can get, the more money you're going to make. And in fact, you make more money when you're selling, obviously closer to 250 delta. The higher the delta that you sell, the more money you make. In fact, but there is some gut-wrenching volatility that you're going to face along the way. So for example, this is selling, just a normal 30 delta 70 T put 9 times. And you see during the COVID drop, I mean, this is this could be like a 20, 30% drawdown on your account, which kind of emulates if you were holding shares, you would have had a 30% drawdown in your account. So there's a lot more volatility when you're holding shares and when you're selling on margin, which is, kind of obvious. So in conclusion, buy and hold outperforms consistently selling puts because the bull market price appreciation is just vastly greater than the premium yield. Now, Z, why don't you just buy and hold or sell 50 or 50 delta puts or maybe even 60 delta puts, like, sell some in the money puts because we're in a bull market. Well, the question is, are we in a bull market? That is the age-old question. At any day in time, you don't know if this is the start of a new bear market. So, and if you're wrong, well, you'll be losing well, I guess just as much money as you would buy and hold, right? Pretty much just as much, but you're not going to make as much money on the way up. Selling cash secured puts is very cash inefficient. You have to, and this is one way people drastically underperform by selling puts. You have to really know how much yield you're getting on those puts. If you're not even making like 1% return on cash, there's not even point doing that strategy, in my opinion, because I mean, you could be sitting in a money market account taking absolutely no risk for probably like half that yield or a quarter of that yield, which I would much rather than getting 1% yield on selling a cash secured put. So you have to be really careful and do your math when you're selling cash secured puts. So as a bonus, I just decided, well, you know, we've been in a bull market. What about selling, buying calls? Why don't you just straight up buy calls every single day? You know, every time we just go and buy some calls. So this is simulating every expiration possible. We go out and we buy 9 calls at different deltas, at different days to expiration. And here's the ending balance. So you can see you still underperform buy and hold. And that's mostly because of 2 things. One is you have to fight against time premium. You know, every day, every second, you're fighting against data. When you're especially buying a 50 delta delta call, you know, data is going to be eating your lunch every day of the week and twice on Sundays. In addition, with only 9 contracts, you're only getting 450, delta, whereas you're buying, 900 deltas of SPY, SPY shares. So you're really only getting half the appreciation, which kind of makes sense if you look at this like number. If you double this number, it'll be like 540. To get the equivalent delta, we probably should have did 18 contracts instead of 9 contracts. So if you multiply this by 2, you get 50, 540, which seems to make sense mathematically. What's also kind of interesting is that it seems like 14 days to expiration outperforms 7 and 28, which is kind of interesting. So if you're doing swing trade longs, maybe consider doing 14 days as opposed to 28 or 7 days. 7 days, I mean, data really kicks in on 7 days. And 30 delta versus 50 delta, 30 delta, 7 days. I mean, that's just data just taking your money every single day. So now I want to mention this is a very preliminary exercise. I don't think that selling puts is a bad strategy overall, and you should just forget it and just do buy and hold. If you don't know how to trade options effectively, I would say buy and hold is, if you're going to go sell puts, I think you're better off just buy and hold. However, if you do know how to sell puts, you do know when to go heavy on put selling and when to not do that and just buy shares or buy futures or whatever. I do think put selling is a great way of maximizing your return on your portfolio. In fact, generally I have about a third of my buying power tied up in put selling, which are all properly hedged with other puts, long puts, and VIX calls. And shares if I need to do that. So I don't mean that this is a bad strategy. I think it's a bad strategy if you just blindly go out there and do it every single day, any chance you get. So I hope you enjoyed this content. Please like and subscribe. Please leave in the comments what kind of backtests you want me to do next. I am probably going to do another video on, okay, what if we selectively sell puts when the VIX is high, or when you think it's the best time to sell puts when the market is dropping. And do some more nuanced back tests. Please leave in the comments what other back tests you want to see, like the wheel, testing iron condors, iron butterflies, etc., etc. Those are all things that I plan on doing going forward. So thank you for sticking it out until now, and I hope to see you in the next video. Bye.